Okay? Because 80% of the time it is positive, 20% of the time it is negative. Now, assume that this is my call, which is that the mu is going to be a static mu. Now, I am here slicing the market with a more limited window, which is this. And I'm going to say, in fact, the level of mu I use for the next period is this one. Okay? So the real one is this, but I'm making a small mistake. But next time, in fact, I'm making a small mistake, but I'm adapting. And during these periods here, which are the downward period, I'm making no mistake. So by having a smaller window and adapting to it, I'm able to capture the changing market conditions better than if I take a very long period of time. Okay? It's not perfect because I'm not predicting anything here, but I'm adapting to a changing market condition. So, in fact, I am better off by assuming that I have some sort of different regimes and accounting trying to account for this. And as a result of that, when the market is changing, I understand that the market is changing, and I can see now, I can understand that I can get a return that is close to the observed one if I want to, because I've got a way to mirror the behavior of the market. So, in fact, what it means is that when I look at the asset classes, yes? No, I wouldn't say that. I would say that basically when you have a momentum strategy, okay, the momentum strategy may be related to 9 months of history or 2 days of history, okay? So in fact here, I'm having a bet on the long momentum history and here on the short momentum history. But above, if you see, forget about momentum and mean reversion here. What I see with this is that I have got no stability in this of the mean and actually no stability of the variance because the variance is going to increase during this period. So making the assumption that I've got a stable mean and variance is a very strong assumption. And when I'm looking at the distribution, in fact, what I'm saying with the ID approach, I'm saying the mean is representative of all periods. It's the most likely. But that assumes, in fact, some stability that does not exist. And it is the reason why here in that case that I've drawn, the reality is much better described by the existence of regime and a regime switching approach than it is by some sort of a Gaussian approach, because the Gaussian approach doesn't take into account the fact that there are some time-changing changes. And here, what I'm doing is I'm looking at various asset classes here, the asset classes I'm considering, and I'm testing, in fact, the stability of the volatility. And what I can see is if 1, it means a weak stability, and 0 means a reasonably good stability, that is that in fact I can see that many of the asset classes have got a 1 and not a 0. Okay, so in fact I'm dealing with a majority of asset classes which are not stable over time. As a result of that, there isn't a right nor wrong period to assess the volatility and the return because there is no stability in this series. So when you go and you are in your job, you assume, and you have got somebody is asking you to build an optimal portfolio based on historical data, what you know now is that there isn't an optimal period to assume to get to an optimization. because in fact there is no stability in in the majority of the series. And actually, one of the things is that it is not that it is clear that these series are, one asset is more, it's not very intuitive here, in other words. And as a result of that, my first reaction, and it's true that it is momentum, but in fact, if there is an existence of regimes, I actually would use a limited history of time rather than a long one, hoping to be within a given regime and hoping that this regime is going to last. So here, we're getting back to a slide that we already saw, which is a rolling window correlation. And what it means here is that, and I think that you've got the rolling window of the average equity-equity correlation, bond-bond correlation, and equity-bond correlation. What you can see here is that there are some periods of relative stability of the correlation. And when I look at the equity bond, it is not the case. So I even haven't got some regimes here. So I cannot say that if I estimate on a small period of time, I'm going to have an understanding of the volatility that is good. Because when I see a slope like this one, if I estimate the correlation on this period, I mean, the period after is going to look completely different. Okay, so in fact, and remember one thing, which is that the correlation covariance approach is much more complex to guess or guesstimate than the mean and variance themselves. So it is something where it's hard to have the proper intuition. So that means that explains that in fact a strategy based on the estimation of the variance the covariance matrix here, especially when there is a bit of movement of change in regime or whatever there is, we're going to get it completely wrong. And it is the idea that if I'm assuming I've got no view and I'm coming with the 1 divided by n, I'm going to be better off than making some bets on the basis of that and getting this. Because in fact, I am, in fact, what I'm doing by getting to the 1 divided by n is I'm saying there is a lot of noise in my assumption, and the more noise there is, the less I'm able to make decisions away from the 1 divided by n. While if I have got no noise, which is the mean variance optimization, I've got a high degree of certainty, and as a result of that, I'm going to consider the correlation matrix as a given that I can trust, and which is going to lead to low robustness and big misspecification. Now, okay, so with this, we understand what is going on, and I think that is going to be very interesting what we're going to do next week, because next week we're going to test various types of portfolio construction to see what works and what doesn't work. So the question we're going to ask ourselves is static versus dynamic rebalancing, large number of asset classes versus small number of asset classes. What else? We're going to look at some smoothing of correlations or covariance matrices over different periods versus covariance matrices estimated on small or large periods of time. Things like that, to understand how they compare all of them with the 1 divided by n. Okay? And it's going to be something that is quite empirical, but it's going to give us some sort of feeling. And whenever I think that it's going to be useful for you when you're going to be in front of your desk in your job, and if you've got some multi-asset type of things, to say, okay, based on my culture, on my knowledge, what is the best way to build my portfolio if I want to use some quantitative tools? Now, you know what? We've criticized a lot the mean variance optimization. Okay, I would like to have some words now about the fact that the mean variance optimization is not completely crazy, which is surprising, but under certain conditions. And let me explain. What I have here is basically, I've got my wealth. Wealth is an amount of money. W is an amount of money. What I'm interested in is I'm interested in maximizing my utility, and I'm looking at my expected utility. Okay? So in fact, the weight, or the wealth at period t is going to be 1 plus x corresponding to the weight in the portfolio, multiplied by the returns in the portfolio, multiplied by the initial level of wealth. Okay? So in fact, it's something that is absolutely true. It's going to be true ex post rather than ex ante. But in fact, my portfolio after a period of time is going to depend on the allocation of the wealth I have. And depending on the returns on each of the various assets, it's going to impact to give me a final level of wealth, W. Now, if I have, in fact, if I am making no crazy mistakes, I have an idea of my expected wealth. It's something that is, it's fairly intuitive. When you have a discussion with your asset manager, the asset manager is going to have a discussion with you to say, are you okay if you are going for a level of return of, say, 5% on average? Okay? If I'm going for close to 0% or 1%, I'm going to be in cash, I'll have high certainty. The higher I go, the less certainty there is. But basically, my expected level of wealth is something that is my central assumption, my core assumption, or my core expectation. Okay? So this is the expected wealth. So here, what I can do is I can decompose my utility of wealth around my utility of expected wealth using what is called a Taylor expansion. Does that ring a bell? Okay, so in fact, all the functions that we have, however complex they are, through a Taylor expansion, can be illustrated around the expected level through, in fact, the various moments. So what I'm writing is that, in fact, the utility of wealth is the utility of expected wealth plus the first derivative of the utility multiplied by the distance between the wealth and expected wealth, plus 1 divided by 2, the second derivative multiplied by, this is called, and multiplied by the square of the distance, etc., etc. So what I'm having is I'm having the various moments. Then the third derivative and things like that. Now look at this. Here, this is true, totally irrespective of the shape of the utility function. We all agree on that, okay? Now, here is the interesting thing. If my, so I have here something which is, if I take the expected utility of this, I have of the expected utility of wealth. What happens is that this term, which is the first derivative, is going to disappear because the expectation of the expected utility minus the expected utility is 0. While what I'm going to have is I'm going to have the variance term that appears. So therefore, in fact, then I'm going to have all the various moments, the skewness, the kurtosis, and things like that, multiplied by the derivative of the utility. Now, what happens is this, is in this, the utility, if I take a quadratic utility function, am I going to have a first derivative of the utility function? Yes. A second derivative of the utility function? A third derivative? No. Okay, it stops here. So it makes my life easy in the sense that all of that disappears. But there is another way it can disappear. It is not related to the utility function. It is just related to the fact that around my expected wealth, the assets are behaving in such a way that I haven't got any skewness, that I haven't got any kurtosis. Because if it is normally distributed, for a normal distribution, I've got the first two moments. The third, the fourth doesn't exist. So in fact, in the case where the assets are normally distributed, well-behaved, I couldn't care less about the type of utility function I use. Because in fact, I'm just interested in the in the second derivative of the utility function, which is fine. And then, therefore, in the case where the assets are normally distributed, I'm perfectly happy with a quadratic utility function. In the case when the assets are not normally distributed, then I need to have a look at the other derivatives of the utility function. So you can understand that when Markowitz came with a bond equity portfolio, if you're making the assumption that the bonds are reasonably normally distributed, that's fine to use a quadratic utility function. Now, when I'm getting with a new funky asset class like, I don't know, commodities and things like that, for sure these guys are not normally distributed. Therefore, it starts to matter really to have a utility function that is reasonable and that is going beyond the second derivative. Therefore, a quadratic utility function doesn't work anymore. So by adding, in fact, more asset classes to the picture, and in fact, the new asset classes that have been added are not well behaved. Think of bitcoins these days, okay? Let's think of adding bitcoins to this. Bitcoin is certainly not normally distributed. As a matter of fact, having a properly devised utility function is super important. Okay? While if I'm looking at the very standard asset class, I don't really care about the utility function. In fact, the quadratic approach could work. Okay? So, in fact, we have, over time, by coming with new asset classes in order to provide more diversification, we have just complexified the problem and making the issue around the utility function more dominant than it was initially. So this is something that, it's good to have in mind and to keep in mind because it is something that is important, well beyond the exams, okay? Now, if we look at the various asset classes, we look at them at various horizons. Because there is also one thing which is asset classes can have different type of behavior at different horizons, on different horizons, okay? One guy may look normally distributed if we look at it on a quarterly basis, but it may look very different from normally distributed if we look at it on an hourly basis. So let's have a look at one thing also, which is looking at some properly devised tests, so we take the various asset classes, the S&P, the FTSE, the Dow Jones, the Eurostoxx, the Russell 2000 for small cap, the Swiss market topics, etc. So various equity markets and various bond markets. And we look at, in fact, so here we're looking at daily observations, weekly observations, monthly observations, and quarterly observations. When with using the test that we're using the test of normality is a test that is considered as the p-value. And what we're saying, well, the measurement is related to the p-value. And what we're saying is that when the p-value is large, that is something that is favorable to a normal distribution. When the p-value is small, that means that we are not in a normal distribution. So here is one thing. When I look at daily observation, I can see that I've got a lot of small p-values. So in that case, I'm quite far away from a normal distribution. When I'm getting to, in fact, the quarterly data, I can see that the p-values are higher. So in fact, it's interesting that there is some sort of ironing out approach, and if I take longer periods of time, in fact, I'm closer. So in fact, the frequency of observation, so instead of taking a daily return, I'm taking a quarterly return. When I look at the distribution of the quarterly returns, they are more Gaussian than the distribution of daily returns. Okay? So in fact, clearly, if I want to use the Gaussian approach or the quadratic utility function, one thing I should do is to use this on a super low frequency basis. Because if I'm using that on a high frequency basis, then I'm quite far away from the Gaussianity assumption. And as a result of that, my mean variance optimization or whatever is related to quadratic utility function is not going to deliver good results. Okay? And this is something, I don't know whether you saw that with Greg. It is that when I am, and there is a behavioral element related to that, which is that if I'm looking at the data too frequently, then I'm getting it wrong. While if I'm getting at the data with a long horizon, then it's more predictable in a way. So it's another, and the cognitive bias that Greg is outlining is the fact that we should look at things generally, especially when we're looking at things with simple tools, on the longer horizon and not on the short horizon. If we are looking at things on the short horizon, we need to have a toolkit that is more refined than the traditional toolkit here, and we need to think of the utility function differently. Okay? I think that for this time, I finished earlier, which is good. Have you got some questions on all of that? Because it's quite, there is quite a lot of material in all of that. So what I would say is that the only thing that you should not bother about in terms of knowing that is the Black-Litterman things and the Black-Litterman equations. If you understand the principles, don't go for that. Now, what I'm going to do for you is making sure that you've got access to the slides where the formulas print properly and not what you probably have with you. Okay? I thank you for this. If you've got any question, drop me a line. We see each other next time with the practical approach for this. You may have, after next week, the coursework. The coursework is something that will probably require the lecture number 6. So it is something where you may not have everything. So what I'm going to do is in fact have a discussion with you. And if you haven't got sufficient time in the end, we will see at prolongating that a little bit. Okay? Have a good evening. Well, what?
Unstructured big data techniques that use non-dimensional
Well, here we're dealing with just the prices. Now we're going to see that you can use some factors. The difficulty is the same here, is that the predictive characteristic of the factor is not going to be stable over time. And therefore, as a result of that, you need to find a trick to account for the fact that the explanatory power of this factor is going to vary over time. Is it something that you've been working on or you're thinking of?
Yeah, for my applied project actually, I wanted to do something that sort of is better at predicting downturns ex ante, so that should sort of change.
Okay. Well, I think that next time we're going to see some tools. My pleasure is going to see some tools which is going to help you with the thinking on this. Okay? Yes. My pleasure. Yes. Thank you.
Quick question regarding the EWA.
I'll see you next week, though.
Are you going to do that?
Actually, I do. Maybe you want to go home. No, I need to do structural growth. First time. I didn't. I've never liked 70.
You've done already 1 and 2.
Okay, so you simplify it further, so you don't have to bother about.
I need to catch up. That's great. I need to. Well, I mean, it would have been nice if you offered, but now I'm pathetic, so it's like. Ox. Totally ox.
You know when you're, like, at the end of the day, we're going to support the same thing. At the end of the day, we're going to support all the same thing. But with the only one right in terms of down and shoes, it's like you're killing the trend. So exactly, you're comparing, say, I don't know, if you stay, you're comparing one to the other. And you know, it's how you had down and so you're more reliable comparing one to the previous one.
So when do I write then? I'm writing.
This one I want to get right. So like the one you showed, that was a crash.
Yes. But I just write when you intended.
Yeah.
Because I can write it tonight.
You're the crash. You're the
Send it.
I understood. I was thinking this way. It's another approach.
Are you working on this type of things yourself, or?
No, not really. I'm more focused on fintechs. I mean, do something different. I was thinking it from that angle.
So what do you mean? What do you mean you're interested in fintechs?
So I'm doing my project on blockchain.
Yes.
I'm looking into how it's affecting accounting.
Okay.
And I'm looking at triple entry accounting.
Okay, that's great.
Yeah. And then I worked with fintech in November
Yes.
to January while
Yes.
in term time.
Yes.
That was quite nice. It was in robo advisory.
Okay.
Yeah, just getting a little exposure.
Yes.
The new evolution of finance.
Yes. Okay. Good. Guys, good night.
Bye, thank you. Bye, have a good night.
Yes.